Have you ever wondered how humans of the Stone Age turned away from hunting animals and beasts for their daily survival to be used to trading and later being dependent on money? Well, in this video, I'll be talking about the origin of banking and money and how it evolved and how is it going so far. We all know that humans of the Stone Age were totally dependent on hunting wild animals for their daily survival and food. Well, the question is then how did they get into trading? Although they were used to on hunting animals, animals were not available in every season in a certain area. So when animals were not available in a certain time, those humans adapted into eating fruits and vegetables and into other crops. Stone Age was not all about eating and surviving. They also had clothes to wear and many other needs. So they decided to trade between each other. And the only way of trading they knew was meat for clothes, clothes for crops, and every other thing they had within them, they traded. Although the system of trading doesn't seem fair in the hindsight, but at that time they thought it to be fair as that's what they needed the most at those times. And then there came another problem. Let's say that it is not the harvesting season for a crop and you are a farmer, then how are you going to trade your rice for another hunter's or butcher's meat? That is a very huge problem and that is going to be crucial for your survival. So the humans decided to settle on a very common currency that can be traded for every other things. So they decided to settle into various things, and for a certain time they used cows as a common currency at that time, as cows were wanted by every other person in the Stone Age. Humans are intelligent beings, and it didn't take them very long time to realize that cows are a very big creature and you can't actually take a lot of cows with you everywhere you go. So they decided to agree on a smaller and more portable currency. And then they found out about gold. As humans realized that golds are rare, hence precious, so they decided to make gold the universal currency system for every other trading. As golds were used as the universal currency for trading, there rose another problem, as you can't judge the purity or the quality of gold that you are trading with. So then came into the scenario goldsmiths are people that are masters in the occupation of judging and inspecting the purity of golds. So the value of the golds that were used for trading were actually measured and inspected by the goldsmiths, and hence the verified purity were actually used for equivalent trading between every other traders at those times. Then came another problem, as golds were not as light as thin paper sheets, so golds were actually pretty hard to carry around in a very large chunk. And there was also a risk of being robbed, as every other person out there is looking for those gold you have with you. So the goldsmiths used up their brain and came up with a business idea that they will store every other person's gold in a safe vault and a receipt of bill which states that certain amount of gold is stored in the name of that person or under the ownership of this person, as carrying these receipts were actually easier compared to carrying large chunks of gold. So humans actually started to trade with those receipts instead of golds, and the goldsmiths used to charge every other person a fair amount of money for storing their gold in a safe vault. When most of the people realized that every other trade were done through these receipts, there were some people that actually started forging fake receipts that were similar to the original, which actually created a lot of problems, hence making the receipts more complex and harder to forge. Although there were many forgery at those times also, it was very low in amount as it was hard to forge with those details. And then within the course of time, those goldsmiths turned them into banks. Yes, the banks we know and use today are actually the successor of those goldsmiths back in the days. And then there came another problem, as there were multiple banks all over the world, so was there multiple banknotes. Banknotes are actually similar to those receipts that I've talked about earlier, and the problem was that there were multiple banknotes and banknote of a bank could only be used under a single bank, which led to a problem that trading was actually harder now, as every other bank had their different currencies of banknotes. So the government took an initiative and created a central banking system, and a country had their single and national currency which actually made into every single trade. So over time these banks actually decided to replace the gold reserves with cash money, as those money were actually used as the central trading system. Although there are some banks that you are gonna find these days that actually have gold reserve remaining till this day. Upon realizing that most of the people left their money stored in the bank and were not actually using those money or cashing out those money, the banks decided to lend those money of bank users to new clients as loans with certain interest rates, which might look favorable for a moment, but there is a risk to it. Let's say for a moment that every other client of the bank gathers together to cash out their money at once. At that time, the bank will not have enough money to give every other person at that time and will face bank run. So what is bank run? Bank run is a problem where there are more clients trying to cash out than the total amount of money reserved in your bank. Situations like these are what led to the downfall of multiple banks. So the government of multiple countries in the world decided to make a standard rule for every other bank that they should obey. That system is called reserve requirement. So what is reserve requirement? So reserve requirement is the minimum amount of cash or asset that a commercial bank must hold in liquid assets. So what is liquid assets then? Liquid assets is the amount of money or property that a bank holds which it can't use in any kind of activities. Let's just say that the bank wants to lend you $50. Then the bank can give you that $50 from anywhere but the liquid assets. So the liquid asset is kind of the reserved money that the bank can't use. Let's just break it down a little further so that you can understand a little better. So let's just say that I have a bank and that bank has $450 net worth. So the government is going to make me store $50 as reserve requirement of liquid assets. So I can use those $50 and those $50 shall be untouched until there is a risk of bank run. Now that the banks were limited to the total amount of money that they could use, they actually made an offer to the clients that they actually can't refuse. So they made the clients not withdraw their money from the banks by offering interest rate in the money they are storing here. Let's say for an example, if you store your money in the bank for 5 years, they are going to give you annual 1.5% interest in that amount of money. But if you decide to withdraw your money anytime before that duration, then your interest is going to be cancelled. That is a type of policy that the banks use to make people keep their money in the bank. And this is how the banks lend money to other persons. Let's say for an example, AJ took a loan of $50 from a bank upon 1.5% interest annually. And the bank is going to collect that interest of 1.5% and keep total 1% of that interest for itself, and it's going to give the 0.5% interest of that money to the clients that are keeping their money for the interest in the bank. That is how the interest business of banks actually work, and how banks charge other person for the interest on the given loan, and they share a part of that interest to the clients of their bank. All said and done about banks and money, let's talk about how these things evolved even further. So I'm talking about cards, credit card, debit card, Visa card, MasterCard, and many other cards that you can come up with. So some people all around the world and mostly bankers decided that money was still a hassle to carry around, and so they wanted something even lighter and more portable to carry around that you can take even into your pockets. Although this sounds kind of funny compared to how it actually started from cows to gold to now into money, they even persuaded it to make even lighter and more portable. And then they introduced cards. There are various kinds of commercial cards, but the most popular are the debit and credit card. So what is a debit card? Debit card allows you to use your own money using a card that is going to work as a replacement for your cash money. And what is a credit card? So credit card is a kind of loan that is given by the bank to you. You can buy everything using the credit card using the bank's money without actually paying for it up to a certain amount of money limit, but you have to actually pay for that in the end of that certain month. And if you fail to do that, then you are going to be charged a percentage of interest on the total amount of money that you have spent. The usual interest rate on those transactions are about 15 to 20%, but there are countries that charge you up to 25%. Now you might think that charging upfront 25% interest is actually huge and a way of scamming you. Well, then you might think that you will be using debit card. But do you know that the bank charges you from 0.5 to 1.5% per payment and transaction done through the debit card? Which means if you start from a certain amount of money and upon multiple transactions, the total amount of that money is going to end up to the bank. And that is another way how banks are actually grabbing your hard-earned cash. And then came the similar problem as the very early days of banknotes. Do you remember how a few minutes earlier I told you that when banknotes were introduced, there was a problem that every bank had their own individual banknotes and was actually pretty hard to trade between banks. And that kind of problem actually came through with these cards again, as every other banks had their individual and independent cards, and they couldn't actually trade between the cards of two different banks. So to solve that problem, they actually created a centralized universal card called the Visa or the Mastercard. And I know that there are actually different uses and different scenarios where you are going to use the Visa or the Mastercard, but I'm just going to make this video as simple as possible so that everybody can understand. So both Visa and Mastercard could be used all across every other banks and universally. And later the banks actually started to accept receiving and cash withdrawal with the cards of every other banks. Now that we have already talked about cows, gold, banknote, money, and even cards, let's talk about crypto. So crypto is a very sensitive topic as it is totally online and digitally controlled, which means that most of the funds that you own are totally digital and you can't physically hold or feel it. Although crypto had a very crazy rise with Bitcoin, but most of the people in the world thinks crypto as a scam, because most of the cryptocurrencies that actually emerged online were mostly scam, and they were to pump and dump cryptocurrencies just to get rich by scamming every other people. I'm not going to talk about crypto right now because crypto on its own is a whole great topic, and if you want to know about it, then let me know in the comments. I might make a video about it. And anyways, if you have enjoyed my video this far, then thank you for watching. And if you're interested about anime, then you should watch this video of mine about top 10 must watch anime that you should watch before you die, or you can watch this video up here about the top 10 tallest building in the world. And I'll catch you in the next one.